Hello, and welcome to the People Express software assignment for Group 2. In our group is Michael McCleary, Brian Alterman, Peter Scaletta, Max Nelson, Zach Gild, and myself, Tony Benuzzi. The first case we looked at was the base case. The plan in this case was to buy no aircrafts and stay at a constant 3 airplanes and only hire enough staff to recover from turnover. This was a great way for our group to use the simulation model and provide a good foundation for the future of our project. Next, Peter will be discussing the historical Don Burr case, which revolves around the failure of the People Express airline.
So next we have the Don Burr case. Our number of aircraft grew at an increasing rate. We started by adding 1 plane per quarter at year 1, 2 planes per quarter at year 2, 4 planes per quarter at year 3, and so on. Next, for our employees, we did 55 employees per aircraft, and this was enough to cover our turnover rate. Next, we had our marketing fraction, which is 15%. Next, we had our price per seat per mile, which was 9 cents. And finally, we had our target service scope, which was 60%. Now we have some graphs to explain what happened in our case. First, we have the stock price. As you can see, at first it was increasing, but then decreased in year 3 due to negative cash flows and high operating costs. Next, we have our growth rates. As you can see, demand is high in the first quarter. This is due to our low prices, but in the end it ended up decreasing in the long run. And next we have our capacity. Again, it is high in the first quarter, but then over time fluctuates. This is due to our changes in aircraft purchases. Next we have our cash flow. As you can see, it pretty much stayed negative until about year 4. This is due to the fact that we were purchasing a lot of aircrafts during that time. However, midway through year 4, we stopped buying aircrafts, which thus caused a rise in cash flow. Next we have our income statement. As you can see, the net income stays about 0 until about year 4. Then at year 4, our operating costs exceed our revenue, which causes the net income to decrease. Next, our average work week increased over time due to our high turnover rate, and our customer service rate decreased over time because of our low service rate compared to our competitors.
I'm Brian. I'm going to be talking to you about our first case, the constant growth case. We decided to go along with the Don Burr model, but we felt that his aircraft purchases was a key reason why he failed, so we decided to change it to 2 per quarter, and we kept employees the same at 55 per aircraft, kept the fraction of revenue the same at 15%, the same price for 0.09 per seat per mile, and the target scope of 0.60 was also the same. As with the Don Burr case, we also did not succeed. Our stock price fell due to our lack of demand and revenue, as you can see by these graphs. Went from 2 all the way down to 0, and our demand and revenues never went up. For our cash flow, it started out poorly, but we did see a short spike due to our increase in revenue. However, our competitors lowered the prices, thus making us hard to compete, and we lost our revenue and overall we had a loss for our net income. Our average work week increased, thus resulting in a higher turnover rate. That led to a lower customer service due to the fact we have more rookie employees and less experienced.
Hello, my name is Max Nelson. The next strategy we're discussing was based on initial aggression. We felt it was critical to develop our fleet and gain a large customer base. We bought 3 planes per quarter in the first year, 2 planes per quarter in the second year, and 1 plane per quarter in the third year. We stopped acquiring airlines at the end of year 3. We had the same idea with marketing, starting at 30% of our revenue and ended up at 5%. In order to balance our large spending on planes and marketing, we kept other expenses low. We started with only 50 employees per plane and with a low service scope. We had a reciprocal relationship with the price, employees, and service scope. As we decreased planes and marketing, we increased these other factors. As you can see, our stock price steadily increased throughout the 5-year period. It started pretty low, but continued to rise with our change of balance of acquisition and marketing to customer service and price. With our initial aggression strategy, we jumped into the market with a huge capacity that grew at a much greater rate than our demand. At around the 3rd year, our capacity and our demand became at a constant level because we stopped our acquisition and marketing. With our initial aggression, you would imagine a very large deficit in our cash flow. we were spending a vast amount of our capital on acquisition and marketing. As we reduced our spending, our cash flow significantly increased. The low net income was due to all the expenses. Initially, the operational costs exceeded our revenue, but around the middle of the second year, our revenue continued to increase as our operational costs decreased. These long work weeks were caused by the initial increase of aircrafts. This led to a greater ratio of new employees to experienced employees. This resulted in increased work weeks due to training. As our acquisition decreased, our employee work weeks were reduced. Once the demand matched the capacity, customers found it increasingly difficult to find optimal seating due to such a great amount of competition. The new employees were also less skilled and unable to provide the full service.
My name is Zach, and I'm going to be speaking about our penetration strategy. Starting off with our aircraft purchasing plan. We purchase one per quarter for the first 3 quarters of every year. Every fourth quarter, we increase by 1 additional plane. For example, in quarter 4 of year 1, we bought 2 planes, while in quarter 4 of year 2, we bought 3, and so on with following years. For our employees, we try to keep them at 55 per aircraft. Every time we increase the service scope, we added employees as well. For the fraction of revenue for our marketing, we started a high amount of marketing at 20% and decreased by 5% per year. For our price, we started at 9 cents per seat and increased the price by 1 cent per seat every year. For our target service scope, we initially started at 60%, but increased by 5% with the price increase. Please take a look at the growth rates chart. Every time we bought an aircraft, our capacity jumped at an aggressive rate. Furthermore, with our high initial advertising, we saw a high rise in demand with a decrease following year 2 because of our decrease in marketing. For our stock price, when we increased our service capacity, revenues and net worth followed, as well, which gradually increased our stock price over time. As you can see in our cash flows chart, it dropped after every year because of the increase in airplane purchases. For our income statement, while we added planes and increased our service scope and price, we saw revenues grow at a constant rate. Similarly, our operating costs increased with the rise in plane purchases. These operating costs kept our net income low in year 1 and 2 and increased starting in year 3 and years beyond. In the average work week chart, we saw a fairly constant average work week for employees because we added employees every time we raised our service scope and plane acquisitions. We saw a rise in year 1 and 2 because of our increase in plane purchases, while service scope staying constant. No new employees were added. For our customer service, we started at a low service scope compared to our competitors. Our customer service scope satisfaction decreased until we started raising our service scope when we saw a rise in our customer service.
Hello, my name is Michael McCleary, and now I'm going to be talking about our best scenario out of 3, the penetration strategy. Ultimately, we saw a greater potential for growth because we had our gradual growth over 5 years. Ultimately, our market value was $1 billion at the end of 5 years, and that's because our stock price rose between $5 initially to eventually $60 per share. And ultimately, we had our highest net income of $137.7 million. Finally, we'll be presenting our static system dynamics model. Our first input would be the number of aircrafts to purchase. That would drive the total number of aircrafts within the company. Based on the total aircraft, that would drive the available capacity of seats available. And based on the load factor of our aircrafts, that combined with the available capacity would drive the demand. We would control the price of the fare, and based on the fare and the demand, that would control the output of how much revenue the company would earn. Next, we have our total costs within the company, and that is made up of 4 costs: the fleet costs, service costs, marketing costs, and interest costs. All 4 of those added together would be our total costs. And if we take our total revenue minus our total costs, that would drive ultimately our net income, and that would be the bottom line within the company. That concludes Group 2's presentation. Thank you for listening.